Good afternoon, and thanks for joining us. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's Higher Education Virtual Town Hall. The presentation you are about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key.
All right. We did receive several questions from many of you in advance for today's session, so thank you for that. We will start off the town hall addressing these questions, but if you would like to submit more questions for the presenters, please submit them via the Q&A inbox, and we'll try to get those as time permits. And now that we have all of the housekeeping items out of the way, I'd like to turn the floor over to Melissa Harman, Moss Adams partner and higher education national practice leader, to get our town hall started.
Thank you, Amy. Welcome, everybody. We're delighted to be here today to go through our town hall. We have a number of these we've covered previously and thought it was time, with some of the new regulations coming out, to revisit what's going on in higher education and answer some of your questions. There are a number that have come in already. We'll have some that come in today. I just want you to know, if we don't get to your question today, one of the presenters will follow up directly with you, so we'll get to you no matter what. Without further ado, I do want to introduce our panelists that we have today to go through some of these questions. Tammy Erickson, she's an assurance partner. Matt Parsons, also an assurance partner. Laura Roos, an assurance partner. Kinman Tong, an assurance partner, all in our higher education practice. And Lauren Haverlock, who is our tax-exempt partner, who oversees our higher education piece of that as well. And then Matt Dinsdale is a senior manager in our higher education practice. So we're all here to answer your questions today. Our bios are in the web council or the webcast console somewhere in here. So they're out there, or definitely just Google us if you want to connect with us. But I'll go ahead and get started. There's a lot of things going on, and I feel like, Lauren, there's been a number of updates to the ERTC. What's new with it? Can I still get it? When does it end? What's going on with it? Can you give us an update with it?
Those are all great questions, and questions that a lot of people would like to know, especially in light of the ever-changing law relating to the employee retention tax credit. So just as a quick refresh, this is a tax credit that's available to all organizations, but I'd say most organizations, but specifically has the most benefit to employers that have under 500 full-time employees. This credit is something that provides a quarterly benefit of up to $7,000 per employee for wages paid for those employers. It's a credit that's also available in 2021, is available to federal, state, local, and government entities and agencies. It was expanded in 2021, but there are certain size thresholds that also apply. It's for organizations that have experienced some sort of full or partial suspension of operations as a result of COVID-19. Now, when this originally came out, it was just for 2020. Then, the American Recovery Act in 2021 expanded it to 2021 for all 4 quarters. Then in November 2021, the Infrastructure and Investment Act retroactively pulled back the employer retention tax credit for the 4th quarter 2021. So as it currently stands right now, the ERTC is available for the 1st through 3rd quarter of 2021 for certain organizations that meet, the definition. For 4th quarter, it's only available to a limited amount of organizations that are considered recovery startup organizations. So most entities in higher education would not qualify as that. But now, as of this week, there is talk that it might be reinstated for 4th quarter 2021. So organizations have experienced a lot of whiplash when it comes to this. Some organizations have gone, there's a couple ways you can get the ERTC. You claim it on your Form 941, your payroll tax form. You can claim it actually ahead of time. So a lot of organizations claimed it prospectively for all of 2021 and got funding at that point. Some of those organizations that claimed it for the 4th quarter have had to request, have had to pay back the credit to the IRS, and now it might be coming down the pipeline that they never had to pay that back. So, stand by to see if it's applicable to the 4th quarter of 2021. But another question we're getting a lot is the IRS processing these timely? How quickly is it? I guess timely isn't the right question, because with the IRS, they're processing things as quickly as they possibly can. And we're seeing that the turnaround on the employee retention tax credit is anywhere between 6 to 9 months for organizations that are preparing amended Form 941s to claim that employee retention tax credit. So there's a lot going on there. If you haven't claimed the ERTC and you think that you might qualify in 2021, you have up to 3 years to file an amended payroll tax form. So you've got some time to prepare your files, to take a look to see if it applies to your organization. If you are a larger organization, in higher ed, we see a lot of entities that have more than 500 full-time employees. There still could be a benefit if you had certain situations where you were paying employees and they were not working. So that's kind of the latest there, and you've got some time to figure it out if you haven't figured it out yet. And it might even be good, because at that point, the government might figure out what's going on with the employer retention tax credit as well. So you might be in good company.
Perfect. So we've got some time, and it's taken the IRS some time to get their refunds. Don't panic. They're coming in slowly but surely on that one specifically. So let me ask you a question, Lauren. I am either a public university or an auxiliary of a public university, and that auxiliary qualifies size-wise. Can I get an ERTC? Because I thought governments originally couldn't get this. Can you speak to that?
Yeah, there are a couple things that you'd want to look at. There are some aggregation rules regarding the employee retention tax credit. So there might be some evaluation as to, are you as a standalone entity able to qualify based on your size and the amount of employees you have, or do you need to step back and look at the entire system as a whole? This is available to government entities. It was expanded for the 2021 tax year, or the 2021 calendar year, for those 3 quarters to be available to certain government entities. So governments run colleges, universities, and certain organizations that might have medical or hospital care that are government run could be eligible for this if they meet the requirements that they've had some sort of disruption to their operations, which I think most entities have, and they have either less than 500 employees for that entity, or if they have more than 500 employees that they've paid certain employees at some points to not work. There could be a credit available to those individuals as well. It's up to $7,000 per employee for those 3 quarters. So it's a significant credit that's available, that's out there.
Don't miss out on free money, is what you're saying.
No, absolutely not. It's always worth it to take a quick look, right? It's always worth it. And if you had any suspension of operations that were essentially about 10% of your operations. So, you maybe had food services or dormitories that had some impact to your operations. That could easily constitute as a suspension that could qualify your organization as having partial impact to your operations.
Perfect. Thank you, Lauren. So Lauren and Kinman, since we're on ERTC, I know we're not talking about PPP, we've kind of moved forward from that, but can I use the same costs for all of these programs that are governmental and beyond that, other government grants? Can you speak to that? What am I allowed to use? Can I use the same payroll? Does it have to be different? What are the rules, or what are the assumptions around that?
I'll start, and then I'll pass it over to Kinman to speak more towards that federal element. But generally, the answer is no, you cannot use the same payroll. We have guidance for the PPP and the employer retention tax credit. You would have to make sure that those costs were separated and bifurcated. You cannot use the same payroll for those amounts. And I believe, that carries over to the federal grant program, and I'll send that over to Kinman to respond to that.
Yeah, and then Lauren is right. So the concept that we talk a lot about is double dipping. There's no double dipping. If it's the same expenses, payroll expenses or other expenses that you have recognized using any federal grant, be it be COVID related or non-COVID related, cannot be then used to be claimed for another federal funding. Be it be PPP or ERTC or any of them. Essentially, you cannot double dip. You can only account for them once when you're submitting for what we call reimbursement or accountability. So.
Perfect. Well, I'm going to throw you a current question we got, which is in line with the accounting, and I think this will be in the vein of everything we say, which is ASC 958-605, which is I've applied for the ERTC. I'm waiting for my refund. Can I book it as revenue now? Can I book the receivable, or when is that point in time? And maybe you can speak in some generalities about that.
Sure. So in general, the guidance that you'll follow, especially if you're a not-for-profit entity, you'll follow the guidance of ASC 958, which essentially is similar to any other grant accounting recognition for PPP loan or ERTC or for any program that you have. Essentially, if you have reasonably assured that you have met the condition for the recognition of those credits, you can recognize them. However, if you think there's some uncertainties or questions about potentially amount, then you will want to hold off on recognizing those amounts. So just it really depends on your circumstances and what you're using to substantiate it. And having good records of that to substantiate it will be great. I do want to point out, we do have clients who will choose to, until we see the money get approved and come in, that's when we'll recognize it. That's also a fair approach. It definitely boils down to what you have consistently applied the approach, you should consistently apply to as well. You cannot pick and choose. For one quarter, you do it this way, and second quarter, you do it this way. Whatever approach you choose has to be followed through for all the similar funding sources.
Perfect. Thank you. Lauren, I'm not letting you go yet.
I also think it's important to know that this is revenue, right? Instead of, I think in the for-profit world, those organizations or companies have the option to net it against the expenses. But since this is grant income, it's revenue, not an offset against the credits. And I think it's totally different on the tax return too. So just be aware.
Perfect. Agreed. And Lauren, I think that's true. Maybe you can address that, because we've already gotten questions on that, because you're absolutely right. There is going to be a difference, and this is going to be a reconciling item. So maybe, Lauren, you can address that real quick.
Yeah, the position that we've taken as a firm, of course, always pending evolving IRS guidance, is that what we have regarding the ERTC from the IRS is that it should offset the expenses for which it is, obtained in the tax period that the credit was for. So in theory, the IRS has said for profits, they should go back and amend prior returns if they have a credit and they need to offset their expenses. We're hoping to get additional guidance for the nonprofit world, But as of right now, applying that logic, it would be different than it is on the GAAP side of things. I do know other practitioners out there who stated that they are going to report it the same as the GAAP financial statements. And so really, until we have something official from the IRS on this or on the Form 990, there are various positions that are out there. But ours is that we conform with what the IRS has currently stated, which is offset expenses.
Perfect. So staying in the vein of COVID funding for a little bit longer here, tell us, has there been any updates to the FAQs related to the COVID relief funds, to the students, and the reporting associated with that, Lauren?
Yes, the IRS has added a couple new frequently asked questions that address situations and various certain situations of how you're using your funds, your different types of COVID relief funds and CARES Act and all the different types that are out there for your students that flow through to them. And essentially it continues along the same theme as what you're using the funds for students is not going to be taxable income to the students. The latest two new frequently asked questions, number 8 and 9, ask if you use the CARES Act funding to offset debts or I think it was overdue balances and discharge that or any sort of tuition and fees that might have been owed for previous periods. That is still not taxable to that student. So no 1099 needs to be issued from that organization, from your organization, nor does that student need to include that as taxable income.
Perfect.
So that's nice.
A couple more quick questions for you, Lauren, and then I will let you rest and we'll move on to some of the other regulations. But we've been hearing a lot around ACE or the ACE Act. Can you talk a little bit? Does that impact higher ed? What's going on with that?
Doesn't seem like the ACE Act, which is something that's currently pending. It's been introduced both in the House and in the Senate in the same format. So we have two bills that are waiting for approval that are the exact same, which doesn't normally happen a lot. That's giving a lot of people in the philanthropic community kind of concern that it might pass in some form. And what the ACE Act does essentially is regulating donor advised funds. So unless you're an organization that holds donor advised funds, or you're connected to a community foundation, the ACE Act might not be of direct concern to you, although it will impact the nonprofit community greatly. It essentially creates 3 different types of donor advised funds with different payout requirements for those funds in order to connect with the donor's ability to deduct a tax return deduction. And this is coming from a concern of, there are a lot of high net worth individuals that are contributing money to these institutional donor advised funds with, Fidelity Charitable that don't have any requirement that those funds go to another nonprofit in a lifetime of a donor, but they're getting current deductions and maybe there's no future benefit to the nonprofit community. So it's creating different types of donor advised funds that require payouts at certain points. And it's also looking to segregate community foundation donor advised funds and put certain requirements around those. Might be something good for the higher education community to say, how can we connect with these donor advised funds in the future if this gets passed, to make sure that we are beneficiaries at some point when this donor advised fund is required to disseminate all funds. How do we connect into the donor advised fund community to have some benefits at some point in the future, similar to what higher education already does for certain charitable remainder trusts and things of that nature. So I think there's an opportunity if something like this does pass. But there's a lot of pushback from the nonprofit community that's looking to say that regulating donor advised funds will be complex for nonprofits, for donors, and for foundations that do have them. So stay tuned. Another one to look out for.
Perfect. And then lastly, I think there has been a lot of discussion. Markets were up this last year. Enrollment was down. Lauren, am I now at risk for having to pay the excise tax on my endowment?
That's a really good question. It is something that organizations should assess. The Endowment Excise Tax, when it was first introduced back with, with our big first round of the Tax Cuts and Job Act, was something that a lot in higher education weren't concerned about. It's a tax that would apply for schools that have over 500 full-time employees that have a higher than $500,000 per student endowment fund. I think it ended up by being that there were maybe 100 or so entities that had an endowment that was so large and an enrollment of such that it could be a concern to them, this tax. But there is no provision that allows for these types of fluctuations that we're seeing during the pandemic with, high returns and, low enrollment. So it's something that should be evaluated on an annual basis. If you have more than 500 students and you have a large endowment, just do that quick math and see if it's something of concern, because it is a really complicated area that you could be pulled into for a year or two, maybe. And maybe there's some planning that you can do around that would help. And it's not just an organization, but it would also be any of its related foundations or other types of related entities.
And no safe harbor, even if you dip into it for 1 year.
Not that we have yet. No, nothing that kind of addresses this sort of pandemic world that we're in.
Perfect. Lauren, great stuff. Thank you so much for updating us on the tax side. Appreciate that. Thanks. Wonderful. Well, there's not much going up on in the accounting side of the house, but just a couple things that I know we've had some questions on or got some clarity on. So I'll start, Laura, with you and talk a little bit about maybe you can speak to the provisions in the non-financial contributed assets side of the house. What's going on there? What do I need to know? I'm a higher ed. I don't really deal with this. I don't need to worry about it, right? Or do I? And what do I need to know if I do?
Absolutely, Melissa. Thank you. I think the first thing to think about is materiality, but don't think about that too soon. Step back, think about where your institution might be getting these non-financial contributions. And maybe think about what that definition is. So contributed services is the first one. You may be a recipient of land, building, gas station, those types of items. Those meet the definition of a non-financial asset. If you are receiving materials or pharmaceuticals, probably less likely, but those also fit in that definition. And then intangibles. So if you are the recipient of cryptocurrency, that could also fall into this definition. So do a survey throughout your organization, see where things might be coming into the institution. Then think about materiality. If you're over that materiality threshold, here's what you got to do. The first thing is on your statement of activities, you need to break out these non-financial contributions from cash gifts, cash and stock gifts. That should be on the face. And then if, also if you have material contributions, look at the disclosure samples that are in the actual ASU. And there are some great examples on the qualitative disclosures you need to make. You need to discuss whether or not you have a policy as it relates to whether or not you're going to monetize these gifts or if you're using them in your programs. If you use them in your programs, you need to describe that. If you're monetizing that, you need to do that. If you have something, you also in this footnote need to describe how you determine the value of that gift. And so something to think about if you find yourself, if these happen to be material transactions to your institution. If you have any other questions, let us know. We'd love to help you implement this standard.
Wonderful. Thanks, Laura. I know it's one of the things that sneak up on us, and we'll get a deferred gift and it comes in and then we meet that threshold. So it's just something to keep on our radar in higher education because we don't deal with it, at least not material transactions from day to day, but it's something to be aware. If you get it, there's new standards. It's all about disclosure. It doesn't change accounting. Perfect. So I'm going to stay on the vein of accounting and let's talk a little bit about leases. I think a lot of us adopted them already. A lot of folks had to do the public path and really tackled it already, but some of us have not. And especially some of the GASB folks have not. So going through that, Tammy, maybe two things you can address. Let's talk a little bit about the intersection of lease accounting standards and P3s and what that means. And then there was an update, a clarification on some practical expedience when applying the lease standard. Maybe you can address those two and just a couple lease updates.
Yeah, you bet. So you're right. On the GASB side, there was a new standard, GASB 94, that has to do with P3s. And in the past, Statement 60, which had to do with accounting and financial reporting for service concession arrangements, provided some guidance for P3s, but it didn't really cover everything. So GASB 94 came out, and this really helps with that guidance. It does provide a definition for what a P3 is and what you have to look at for whether or not that's a P3. But there's also at times where P3 is really considered a service concession agreement, in which case you go back to Statement 60. And there's basically four criteria that every single one of those has to be met for it to be a service concession arrangement. And sometimes those P3s can also be lease agreements. And so again, you have to really look at the contract itself and go back to the standard to look at really, do you have something that falls under GASB 94 with the P3s? Do you have something that really is a service concession agreement that you need to go back to GASB 60? Or do you have a lease agreement that goes to GASB 87? So again, that GASB 94 kind of provides some additional information surrounding that so that you know which guidance to go to depending upon what kind of a contract you actually have. With regards to leases, with FASB, leases have been around forever. It seems like we've talked about them, and then it was finally time to implement. FASB went through and has provided several practical expedients to help with that. There's 6 of them out there, and so something to certainly be aware of. The first one is it's a package of 3 practical expedients that you have to adopt either all of them at once or none at all. You can't pick and choose between those. The 3 are, there's one in which the entity does not need to reassess existing or expired contracts for lease classification. So for example, a lease that was classified as an operating lease under the old guidance, ASC 840, they don't need to go through and reassess for the classification under the new guidance, ASC 842. The second one within the set of 3 is that an entity does not need to reassess existing or expired contracts for embedded leases, because sometimes you can have a contract that has some lease provisions and some provisions that do not fall under the lease, that it's an actual lease. And then the third is the initial direct costs under existing leases do not need to be reassessed under the new definition. They can pull that in. So again, you have to do all 3 or not at all. Another practical expedient is the kind of hindsight expedient, which allows an entity to look at hindsight in assessing the lease term and other contract conditions upon transition. And this could be beneficial, for example, if an entity intends to adopt the new standard using the full retrospective method. In other words, you're applying the principles to both periods in which comparative financial statements are shown. And in that case, hindsight can give you some additional information that you can say, hey, back in our comparative period, year 1, we were planning on renewing a lease, but we hit year 2 and we decided not to. Since you know that, you don't have to assess that back in year 1. So that's the hindsight. There's one for land easements. If you have any land easements, those may have been accounted for as a lease under ASC 840. Indefinite Easements may have been accounted for as an intangible asset. And so this expedient allows an entity to really effectively carry forward their prior treatment. However, easements that were treated as leases under ASC 840 are not eligible for this election. They would still need to be reassessed under the principles of the new standard for proper measurement and accounting. The fourth one is short-term lease exemption expedient. And this is one that if you have a short-term lease, it's 12 months or less, that you do not have to apply the recognition for those leases. This is great. However, you do have to consider whether or not you have options to renew those leases. So renewal options that you're reasonably certain to be exercised, that does then create that lease to be longer than 12 months. You would have to still assess that. And if you have a lease that's your lease is January 12 months and a day, it would not qualify for this either. Another one is the lease and non-lease component expedient, and that's where you really identify the lease and the non-lease components within a contract. Typically, you're supposed to bifurcate. So an example might be you have a copier lease that also has maintenance services related to that copier. You would typically bifurcate those. You'd have the lease component, the copier would be accounted for under the lease standard, and then the non-lease component that would be expensed. But with this expedient, you don't have to separate those out for adopting this. And then the last one is the risk-free rate expedient. This one is very helpful because it's oftentimes difficult for entities to know what their implicit rate is. That rate has to be for a comparable period. So if you have a 3-year lease, you would have to know what your kind of borrowing rate is for a 3-year period, a 10-year lease versus a 10-year borrowing period. So it can be very difficult to determine what that is. Therefore, this risk-free rate expedient can be used, and this really allows non-public entities to use the risk-free rate, so like your U.S. Treasury rates, for the discount when you're computing that lease liability. And that's nice because U.S. Treasury publishes rates for, daily versus 1 month, 6 month, years, etc. The only downside to this is Treasury rates tend to be low, and therefore with a lower discount rate, your liability might be larger than what it otherwise may be, but it can certainly save a lot of time. So those expedients all can really help in adopting this standard.
Perfect. Thank you so much, Tammy. I appreciate it. And I think it's something to revisit if, even if you did adopt it, to think about some of these practical expedients moving forward.
Absolutely.
Agreed. I'm going to move over to what I think a lot of folks have questions on, which is the higher education emergency relief funds and some of the federal funding. But as we transition to that, I think, Kinman, I would ask you, I've heard rumblings about the compliance supplement, which is obviously the rules by which we audit which obviously impacts those auditees. So anything for the auditees to know at this point?
Yeah, great question. It's currently still in the works. We believe that is, getting through reviews and whatnot. We do anticipate it to come out earlier this year than prior years, because especially in relates to the HEERF programs. But we don't expect there to be significant changes other than clarification for some of the new provision that is included in the HEERF 3 in regards to some of the spending and whatnot, which I think my colleague will cover shortly as well. But the great news is we don't expect there to be big changes, but it will stay the same way as, the same consideration where it'll most likely be tested as a major program if it crosses the Type A threshold.
Agreed. And I think we've warned our needs. I know a lot of us have warned our clients it will still be there. It's the gift that keeps giving.
Right. Agreed.
Perfect. Thanks. Moving on over to higher education emergency relief funds. So Matt Dinsdale, questions for you. Let's just start with a broad question. There's obviously a fourth round of higher education emergency relief funds. What do I need to know as an institution? How can I get that? Can I get that? Should I apply? And when can I, what is the period of availability?
Sure. So there was a new round. It is actually part of the ARP funds. And so the Department of Education has put out what they're calling a supplemental round of funding. And this one is a little different from the previous ones in that it's a need-based grant. So it's no longer a formula-driven where universities get a portion of that. It's really based on a number of priorities. There's I believe 5 priorities. Each one is different, and so what you'll want to do is read through those on the Federal Register. There's also some guidance on the Kubo out there, but you'll want to read through those and determine which one you might fall under. In regards to whether you should apply or not, I mean, there's really, you might as well just try to apply, and if the worst they can say is no. So go ahead and apply if one of those priorities you think might meet your condition. So there, in regards to the types of things you can spend them on, it's very similar in regards to the same ones that you saw in ARP. So you'll see those same sort of types of areas they want you to spend it on.
Perfect. So we've gone through now, I'll call it the 4 tranches, right, of higher education emergency relief funds. When do I have to use each of those? And then I think, too, any lessons learned that folks need to know as they're moving through them, anything in the reporting side, anything on the allowability side that just gone through now 2 years of audits. What is there, especially from an auditor vantage point, that we can give feedback on?
Yeah, so there is a deadline to meet in regards to spending the funds, and each tranche has you should have received a notice, kind of a grant contract that indicates that period of availability, and it's about a year. It is a year from when you received that notice and received your funds. So you'll have a year to spend it on an accrual basis. So that's your timeline. In regards to best practices and kind of what we're seeing, in our audits is really, the nature of this funding. It was emergency there, so folks had to shift and create systems and processes to not only manage the funds, but also manage some of the reporting and whatnot and eligibility determinations. So if you weren't able to fit that into your existing control cycles, you kind of needed to create new ones. So in regards to that, the first one I wanted to mention was really to document. In the audit world, we say if it wasn't documented, it didn't happen. So that means when you're looking at creating and posting up a quarterly reporting report under HEERF, you'll want to make sure you document somewhere where you posted that, what time, what day you posted that, so that if the auditor comes or the Department of Education comes, they can see where it is, when it was posted, who reviewed it. We have seen some cases where the Department of Education's reached out to universities to ask them where that quarterly reporting is on their website because it wasn't very obvious. So I would recommend making sure you put it somewhere easy to find and then document how you reviewed it and when you posted it up there. Let's see here. So ARP is now, the HEERF 3 and the supplemental funds require that you use part of your funds to monitor and suppress COVID and then conduct outreach to students on potential adjustments to their funds they received. And so that's we don't have a lot of guidance on that. That's pretty much all we have right now. So if you're looking at spending that HEERF funds, you'll want to document it, in a memo or somewhere to show how you met those requirements when you did spend out your HEERF 3 funds and your supplemental HEERF 3 funds. Also, quick note that the Department of Education did disclose that they are planning to change the quarterly reporting in a recent notice. It looks like they're going to start adding some of those items that you'll see on the annual reporting to the quarterly reporting. And it'll probably be effective on the April 10th due date of the next quarterly report. So you'll want to make sure you get the most recent reporting template and look at that guidance before you submit up your quarterly report for the first quarter of 2022. So I think that's kind of all I have.
Perfect. No, Matt. Well, so this is a question maybe Matt or Kinman that had come in. Do I have to meet all 5 priorities to apply, or can I just meet 1 or 2, or what are the rules around that?
You really only need to meet 1 of those. So each one kind of refers to a different type of situation that you might be in. I'll say a lot of them look like it's addressing issues where maybe a university didn't receive the right amount, or they weren't eligible under a previous tranche. So they're trying to fill that gap. There's also certain eligibility requirements where they're trying to push funds to, areas where there's lower income or folks that might not have access to universities. So you'll want to make sure that you fall within one of those. You don't need to meet all 5 of them at the same time.
Well, I would just add, certainly just because you apply doesn't mean you're guaranteed to receive funding as well. So I think there's going to be a lot of decision-making by Department of Education still to come with how the allocation will be determined.
Okay, perfect. No, great. So just, I think you said this, Matt, but I know it was a question that we got earlier. So with this 4th tranche, which you made clear was part of ARPA, we're not going to see allocation tables. This is the way we saw the first 3. It's not going to get posted. We don't get our grade on a scorecard and figure it out by going to a website. It is an application based, so very different than the first 3, correct?
Correct. And so we don't know what it's going to look like. They may send out a public notice of who received what, but for the most part, they're just accepting and receiving in all those applications now, and then they'll make a determination based on need.
Okay, perfect. I think there was a comment or a question earlier about potentially a Department of Education extension for HEERF 3. I'm not sure if any of you have seen that come through or could comment on that.
Matt, Kinman, you want to take that one?
I haven't seen a notice, but I'm aware there was a Department of Education webinar, I think, earlier today as well. I think we were all preparing for this one, so we'll follow up and, of course, get back to you maybe in our next town hall if there is.
Perfect. Thanks. Excellent. Or update our alert. So just, and we'll definitely follow up. I know we have some slides at the end that show this, but we do have an FAQ for higher education emergency relief funds that we keep live. It is on our landing page. So anything new and emerging as it relates to this, we are updating it. So we'll definitely direct you to that as soon as we have legitimate updates that are coming that are regulatory based on that as well. Perfect. And I think the last question for you, Matt Dinsdale, is related to proprietary or schools. And, what is there a clear definition on that? How is that impacted? Could you speak a little bit to that?
Sure. So a proprietary school is defined as a for-profit university. So not a government, not a nonprofit, a for-profit enterprise, and that's what they mean by proprietary school. It kind of comes into play, when we're talking about HEERF. The new supplemental tranche doesn't look like it's being provided to for-profit or proprietary universities or schools, so they're not eligible to receive those funds. You also see a little difference there, in the ratios, the financial responsibility ratios. Those are different between proprietary schools and then other universities. So those are the kind of 2 areas, I guess, in our world where we see differences.
Perfect. And I think I'll just add in, I don't think everybody can see the questions that are being submitted, but we've gotten some folks that have come in and said, and this is unconfirmed, so I just want to caveat that, but it sounds like under CARES Act, if there was an unspent balance of $1,000 or more, there's an extension through June 30th, 23. We will, of course, corroborate and update our website accordingly, but that is what some of the attendees are saying that the Ed announced hot off the presses this morning. So just sharing that because I don't think everybody can see that. So Matt Parsons, I'm going to stay a little bit on education, Department of Education for a bit longer. And let's talk about the easy audits. So we've got anything COVID related from last year. We got an extension to do the single audits for 6 months. Does that mean I get the easy audit extended, or what do I have to do for my easy audit filing?
Yeah, we waited a long time last year to get confirmation through the Federal Register about how the easy audit deadline would, whether it would follow suit with what the Office of Management and Budget provided as far as extensions. And so we do have confirmation that until the emergency order has been lifted by the Department of Education, which I think we just saw recently, earlier this month, that it's been extended, that there is an allowance. So traditionally, the easy audit was required to be submitted by public and private institutions within 9 months of their fiscal year end. So for any June 30 filers out there, that would be March 31st coming up. However, we do know that under the guidance for the OMB, there was a 6-month extension granted pretty blanketly across the field through June 30 filers, meaning that even today, a June 30, 2021 year-end organization would have until September of this year to finish their single audit and submit their data collection form to the Federal Audit Clearinghouse. Now, the one caveat that was given is that if an organization does elect to take that extension past the traditional 9 months, you must submit your easy audit filing the same day that you complete your data collection form. What that also means is if you complete your audit in a timely fashion, right, under the traditional 9 months, and you're not electing an extension, you still then are bound to complete your easy audit filing within that same 9-month window. So it really does come down to some semantics and making sure that you're understanding when your single audit is done. And again, not necessarily when the report is signed, but when is the submission of your data collection form been completed. Now, I don't know that there's going to be significant, follow-up if you're a day or two later than your submission of your data collection form, but try to keep it, I think, as tight as possible. Because traditionally, even before that 9-month original extension, you had about 30 days was the recommended guidance for getting it turned in.
Perfect. Thank you, Matt. That's great. Staying in that vein of federal reporting, I think there's been a lot of questions because there's so many things moving with these grants, because these higher education emergency relief grants and some of the other COVID funding covering multiple years, and then also recovery of prior year costs, and we're crossing over year ends and a lot of confusion on that. Maybe just a reminder on how we're instructed to prepare, and I say how, higher education, we are instructed to prepare the schedule of federal expenditures. How just a reminder there, when we're thinking about that, how we're reporting the grants.
Yeah. So the guidance is that when you're preparing your schedule of expenditures of federal boards, the CFA, that should mirror really the accounting basis that you're preparing your financial statements on. Because the auditor is giving an opinion that the schedule is reconciling back to what the financial statements are reporting. Now, with lost revenue, that gets a lot more complicated, and it's definitely added a new wrinkle to the reporting that hasn't necessarily been contemplated by the OMB or the Department of Education. And so certainly there's been other departments, other programs that have given specific guidance to, hold off, don't report lost revenue on your CFA until a certain reporting period has been met. We have not gotten that exact clarification for the Department of Education. However, We know that the ARP funding, specifically ARPA, came out really late, especially for any May or June year ends last year, and there wasn't enough time to assess, am I going to need to use lost revenue as a basis for reporting this year? We may still have additional costs, not knowing what future waves at that time we're going to require expenditure-wise. And so we've heard of some organizations coming into and thinking about what funding they have left. Oh, we should have applied some lost revenue for our prior fiscal year, maybe again before May or June. Do I need to restate my CFA from the prior year if I'm going to capture some of those lost revenues? There's not perfect guidance out there to say yes or no one way. However, again, using the guidance that we've heard from historical examples of other programs, if you had recognized revenue that prior year based on that lost revenue condition, and you're going to record it this year as a result of now identifying those costs of being allowable, then it probably makes sense to report it on the current year CFA. I definitely recommend you talk to your provider, your auditor, to sort of walk through the scenario. If it was an error where you truly did miss potentially reporting something last year, that's a different scenario. But I think we're all realizing, again, from a timing perspective of when this funding came out, there's probably some fluidity to that and understanding of when it gets reported. But I think this is probably the last year for that risk, because we know, again, other than with the extension that we just highlighted, most of the funding, I would imagine, is going to be captured within this next 6 to 12 month period.
Perfect. So it depends, sort of, but definitely consult. No, perfect, exactly. A couple other things, Matt, just emerging issues in higher education that we really want to get top of mind as we close out here. And just a reminder, if folks have questions, please submit them. And if we don't get to them, we will get back to you regardless. So a lot going on with ISAs. The Department of Education recently sent out an alert. I'll call it a reminder. You want to speak briefly about what they said?
Yeah. So although income share agreements or ISAs, like you mentioned, have sort of risen and waned in popularity and use, I think, over probably the past few decades, it seems that because of the attention to student loan debt, there are many more institutions considering offering these income share agreements or arrangements because they see it as an alternative to a traditional loan. And these often are arrangements where a student does not, make tuition payments while they're getting instruction. Instead, will make payments once they've been placed in a career or an occupation. And then the tuition rate may change based on, again, what their level of income is at that time. And so in any event, the Consumer Financial Protection Bureau, or the CFPB, and the Department of Education both clarified, regardless of sort of what you call it, whatever description you label it, this is a loan in their eyes. And it is subject to the Truth in Lending Act, which means that, there's disclosures to inform the student that, this is a borrowing. They have a choice when it comes to lenders. And it also puts into perspective some policies and procedures in place by the institution making the loan, such as having a code of conduct requirement. So I think this is like a PSA warning that, if you have not, or if you've potentially engaged in these types of loans, that, you want to make sure you're following all the traditional guidance under the Truth in Lending Act.
Beautiful. Perfect. It's a really good reminder because it's a confusing product. And I think for a lot of folks in understanding what it is and what they're subject to. And on the same vein, talking about loans, right? So we've seen a lot of press around the cancellation or forgiveness, I should say, of student loan debt, the Navient and the eligibility piece of that. Does that impact me as an institution? Do I have recourse in that? Am I on the hook? Like, what do I need to be thinking about as an institution of higher education as it relates to that massive cancellation?
Yeah, so for what we know today, and there's been obviously a lot of discussion at the national level about student debt and forgiveness. As of right now, especially with the Navient case, it really does relate to specific institutions that had marketed themselves in a specific way that the Department of Education agreed felt like it was, not promising to deliver what they had originally made. And so it's about a little over $1 billion of debt that was essentially forgiven as well. But there's a lot of other terms, again, associated with who those borrowers were. But again, we don't expect it to have a current impact on any traditional, either public or private institutions. It was really limited to some very specific schools. One thing to be aware of is that, Navient essentially transferred all of its loans out as of September of last year. I think 5.5 million borrowers were transferred to a new service provider. And so, we don't know what that will bring in the future, and if there'll be any impact, of working with schools to potentially renegotiate some of these historic loans. But there's definitely a possibility with the current conversation going on.
Wonderful. Perfect. I think those are the questions we have at this point. And again, if folks have, you can see our contact information if you want to follow up with any of us directly on this. Before we go and close out with some housekeeping, the one thing I would tell you is, what do we need to be thinking about for our fiscal year in 23 budget? So whether you've already had them approved, whether you're going through a budgetary process right now, or whether you're thinking about modifications, I think this is changing. I think all of us had hoped that the days of updating constantly our budgets based on what was going on with the pandemic are not changing. I think we have now these inflationary factors that we're talking about, even possibly ending the year with a double-digit inflationary factor is what I'm hearing from some of the economists that I've listened to. We also now are going to have the supply chain shortages that we're seeing with the war that is going on in Ukraine and Europe and Russia. So we're seeing bigger issues as it relates to that. So I would say thinking about your budgets, and the nugget we can leave you with is to make sure, and I'm sure you are, is really communicating with your boards and others that this is going to take more of your money, have the inflationary factor related to payroll, related to fuel-related costs, related to cyber security and what's coming next, and really preventative measures to ensure that you're really thinking about all the costs that we're going to have to bear in the next few years and trying to be insightful in that. And I know that is just top of mind and in considering that. And probably we can go on the things that are going to be impacted on that, but just a couple of things. I think we're at the top of the hour. We're going to have to close it down. This was fantastic. Thank you to all the presenters for everything they've done. We do have a lot of insights and resources that you can go to. Our higher education landing page has, like I mentioned, the FAQ on higher education emergency relief funds, which we keep live. And update that. The contact information for all of our presenters is included in there. And we will be obviously going through this in another time. As we accumulate issues that are hitting higher education, we will call another town hall and bring everybody together. So look for more. Also look for us at these events. We will be presenting at these events. We hope to see you there, and excited to have some events that are back in person. So definitely look us up and come by our booth at Wakubo, and delighted to be obviously seeing you again. With that, Amy, I'm going to hand it back over to you to do a little bit of housekeeping to close us out.
All right. Thank you, everyone, for a great discussion today. I just want to let you know that we do have a link here to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you for joining us. We hope you'll join us again next time. Take care, everyone.